All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. And upon downloading that ebook, you will be put into my email distribution, and you will start to receive my weekly newsletter called the Cubicle Weekly Reader. It comes out every Monday at 10 a.m. Eastern Standard Time. And I'll talk about everything from the world of investing to, finance, economics, cryptocurrencies, et cetera, et cetera. And from time to time, I do give book recommendations. So I'm an avid reader, so I do, from time to time, give out book recommendations. So nevertheless, you definitely want to be a part of the Cubicle Weekly Reader readership. So today is December the 10th. It's approximately 8:30 p.m. Eastern Standard Time. Yes, I was up looking at some stock charts, and I thought it would be a good idea to make a quick video talking about the importance of knowing how to determine whether or not IV is high or low. And that's important because, because IV affects the premiums that an option seller receives, and also it affects the premiums that an option buyer pays for an option contract. So knowing how to determine when IV is high or low is extremely important in the world of options trading. So some years ago, I developed this spreadsheet here that I call the Implied Volatility Gauge. And what it does is it quickly, by inputting just three variables. So for example, I'm looking at ROQ here. So ROQ is a ticker symbol. And what I did was I input the three variables that will help me determine whether or not the current IV ROQ is high or low based upon or comparing it to the historical IVs over a 52-week time period, right? So the highest IV for ROQ over a 52-week time period was 134. The lowest IV over that same time period was 57. And then the current IV, now the market is closed, of course, but this past Friday, when the market was open, the current IV or the IV of ROQ was 73. And so, Eric, where did you get the historical IVs from? Well, if you click on this button here, it takes you to a website, and the website looks like this here, right? So this here is a screen capture of how the website looks. And so there's a text box where you can type in your ticker symbol. So of course I typed in ROQ, R-O-K-U here, and then you're looking under this column for your 52-week high IV, which will be gotten from this shaded area here. Again, look at the website. And then your 52-week low will be gotten here, again, from that same shaded area on the website. And then the current IV, essentially you get from here. It corresponds to the IV index mean, right? And so again, you get that from clicking this button here. So for those who are subscribers, so if you haven't subscribed yet to the channel, please subscribe. And if you're interested in this spreadsheet, just send me an email to info@cubicleinvesting.com. And if you're a subscriber, so let's use some integrity here. If you're a subscriber, I will definitely send you a copy of this spreadsheet. And so as you can see here, by putting in those three variables, the 52-week high, low, and then also the current IV, it creates a spectrum here. And that spectrum is put into 5 buckets, right? So you got the very deflated bucket, deflated, the premiums are fairly priced, premiums are inflated, and then very inflated. And so you can quickly determine, based upon the highest IV over 52 weeks, the lowest IV and then looking at the current IV. And so all the math is done for you. And so depending on where the black dot falls, it gives you a recommendation of what kind of option strategy you need to look at to implement based upon the current IV in comparison to the historical IVs for whatever underlying you're looking at. And in this case, we're looking at ROQ. And so this here is a quick way to determine whether or not premiums are, inflated or deflated. Because if you're an options buyer and you don't know whether or not premiums are inflated or deflated, let's say the premiums are very inflated and you're looking to buy an option contract, well, guess what? You're going to be paying too much, right? And conversely, if you're an option seller and you don't know how to determine whether or not IV is high or low, if the IV is very deflated, then as an option seller, you're not going to receive a significant enough credit to be putting capital at risk for selling an option contract or, selling a vertical credit spread. So it's very important that as an options trader that you have some strategy or some process of determining whether or not IV is high or low, because IV affects the premiums in which, again, option sellers receive and option buyers actually pay for buying an option contract. So again, if you are interested in this spreadsheet here, if you are a subscriber of the channel, then send me an email and I'll be more than happy to send you a copy of my implied volatility gauge spreadsheet.